Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
So the novice makes the same two mistakes every time they place an order. They sell after prices fall from higher levels, and then they sell into an area where in the past prices have rallied. And this is exactly the picture he showed me back then. And believe me, folks, I couldn't believe it at first. I didn't understand it, but I saw it more and more, and it started to make perfect sense. It's the same thing when a novice trader makes a buy. They're usually buying after a big move up in price and buying into an area where there's leftover sellers. And if they were to look to the chart would tell them that, okay? But they're not really looking at that. Their indicators are telling them to get long. Their oscillators are telling them to get long. Prices are rising, so they figure they're joining a nice uptrend. And buyers are buying at a price level where there are more sellers than buyers. And that's mistakes that every time a losing trader makes it, it's the same two mistakes. So this is the same thing he told me many, many years ago. Now I combine that with the business cycle, which I've talked about here many, many times. And I started to use this information in as kind of a trading plan that I put together for myself. And of course, if you follow the business cycle at certain points in time, down here at the early recovery stage, it's always going to be one of those markets where everybody's gloomy, everybody is afraid to buy. Most of the time, they're buying up here late in the cycle. Again, the same mistakes that everybody makes. They get so eager to buy right at the top, and then of course they have to panic out at the bottom, usually for reasons like margin calls or just they can't take the pain anymore. So this cycle here is very, very important into my thought process in trading. So I'll kind of review these four stages which I combine with the business cycle. We have a period down here which we call consolidation, where there's no dominant force in the market. Buyers and sellers are in balance, equal force. For whatever reason, prices break out of this, what we call the accumulation phase, and they begin a new uptrend. And during this uptrend here, the novice trader, of course, he's pessimistic. The news is negative. He's afraid to buy, so who has to buy from him? Well, obviously, the professional is down here doing the buying. Because the professional and the novice, they usually buy and sell at just about the opposite ends on the chart. Notice as we see the primary trend here start to go up, we also have the intermediate term trends where we have these little retracements as this trend is going on its way. Eventually, though, the novice starts to see, the public starts to see the uptrend, the higher highs and the higher lows, and they get in there and they think, okay, let's buy. And sometimes they're buying early, which is okay. Of course, as this trend continues, now comes the greed part. Okay, this is the one emotion that starts to take over here. If you bought down here anywhere and you're up here, you're thinking pretty good about yourself. You're talking to somebody who went through all of these emotions in the bubble of 2000, folks. So I'm only speaking to you from firsthand experience. When we get up to this stage up here where we start to trade sideways once again, we can call it a stage 3 top if prices close below this area here, because now this indicates that we have some kind of a distribution and we're beginning that downtrend phase. So we have our accumulation, we have our uptrend, we have our distribution, and then we have our downtrend. And remember, up here at the top, this is the last place you want to be buying. So if everybody's telling you to buy gold after a big move up in price, watch out. If everybody's telling you to buy oil at $200 or it's at $150, it's going to $200, watch out. You might be the guy buying the top. Now, once the stage 4 decline phase begins, once we close below this place and we start the new downtrend, investors are hopeful. They're hoping I'll hang on because prices will come back. It's a good stock, okay? After a while of this downtrend, which during this downtrend you'll have these intermediate rallies here, these short covering rallies, and that'll be the intermediate term trend to the primary downtrend. eventually, the farther this goes, the more fear sets in and eventually panic. And of course, the panic it leads to people selling right down here at the low to, again, the pro who happens to like to buy low and sell high. Another way for me to view a trend is when price is moving vertically. It's because there's very few sell orders to slow the buying momentum. So this, again, was the way Sam explained it to me, and it really was helpful. So it helped me to organize my mind that when I saw prices moving up, it was because there wasn't very many sellers to stop it. But once it reached a large pocket, and the picture really from the previous slide would always look like this. It would have that rally followed by a topping period like this, followed by a decline like that. So I came to number them. Well, if it's 2, 3, 4 like this, I would short the rally into the origin of this move. And lo and behold, there'd still be sellers up here. So everything that Sam taught me, plus what I had learned about these 4 stages from Mr. Stan Weinstein's book, which is where I learned this, kind of all came together for me. I says, you know what, these areas of resistance here, they're resistance until they're not. So I made that a part of my trading plan. Down here at the bottom, you'll see this little decline followed by a basing period and a rally. And you could actually say that's down, sideways, and up. You want to start to buy pullbacks. And that was the other part of my trading plan. If the market's going down, sideways, and up, I buy dips. If the market's going up, sideways, and down, I short rallies. And now you pretty much have my entire trading plan. Now, once price reaches a large pocket of either buy or sell orders, price begins to move in a horizontal manner to absorb the resting limit orders at this price level. So in other words, when you start to see price going sideways, instead of thinking of it as just random movements, it's probably because there's a lot of orders at that price level that need to be absorbed before price can either move higher or lower. So Sam once again would say the largest stack of orders above and below current price would be where the true buyers and true sellers were in the market. And by him handling the institutional order flow, he would have a really, really good idea where that was. So when I see those pockets where price is based for a while and then dropped, I right away think of a large stack of sell orders at that price. Unsatisfied sellers. When I see a large place on a chart where prices go sideways and then rally, that's that large stack of institutional orders. That's my interpretation of it. And so what usually happens is this is the way my mind works on this graph. Price kind of moves up, and if there's a lot of sellers at this price, more sellers than buyers, price probably moves back down to where there's a lot more buyers than sellers. And this is an ongoing thing that happens all day long on every time frame imaginable. And once you start to look at it this way, it's pretty interesting. And for me, it's easy now, but believe me, I didn't develop this thought process overnight. So here's a picture of our Japanese yen, the yuck, on a daily chart. And so now we're kind of putting this all together. Here at this 99-cent level, I've got 20,000 to sell. And as Sam would say, those would be real orders. That would be an institution that called in before the market opened. He's not likely to make any changes to his position. This could be a level 2 in the NASDAQ, and this could change from minute to minute because a level 2 in a NASDAQ is just willing buyers and willing sellers. But the way it was explained to me, these are firm orders, these are real orders, and until this last sell order is filled, price is not going to go higher. And so when price revisits these areas where these orders are resting here, down here at this 95-cent level where there's a lot to buy, and up here at this 99-cent level where there's a lot to sell, price is going to trade back and forth until either all of this is absorbed, all these buyers are absorbed, and then you can go lower, or all of these sellers up here are absorbed, and then the trend can continue higher. So this is the way I look at a price chart. And I can see this picture, again, this is a daily chart. This is visible all the way down to a minute chart. And so what really happens here in trading is behind the formation of every one of the candles, there's just an ongoing buy and sell equation happening here. Buyers and competing forces, two of them side by side. If the number of willing sellers drops to 0 and you have any buyers left here, prices must rise. Okay, so the origin of the change in price is an equation where one of two competing forces becomes 0 at a specific price.
Thank you for listening to our podcast.